Silver dealer bid prices have declined by an average of 14%, and this is going directly against the typical pattern for this metal. This abrupt reduction has every silver investor stopping in their tracks, and it should. Historically, reductions in dealer buyback offers typically occur only when liquidity providers anticipate structural instability or accelerated repricing risk. In plain English, this means you are getting less cash for your silver. In this video, I will show you how dealer pricing behavior exposes hidden shifts in market liquidity before they appear in headline silver prices. Next, I will break down how these adjustments reflect deeper institutional positioning changes. And stick with me all the way until the end, because I'm going to explain to you how understanding these early signals can determine whether investors protect or unintentionally lose over 20% of their silver's real exit value. What makes this development particularly dangerous is that more than 74% of physical silver holders rely exclusively on spot price feeds, even though dealer buyback prices often adjust 8 to 16 trading sessions earlier. Listen closely, because dealer pricing reflects immediate exposure to real-world supply and demand imbalances rather than theoretical market equilibrium. Dealers operate within inventory turnover windows averaging 19 to 31 days, meaning any increase in volatility exceeding 12% within a single month forces rapid defensive adjustments. When silver's peak-to-trough movement exceeds thresholds of approximately $30 per ounce, as occurred earlier this year, dealers must assume the probability of continued instability rises significantly. Their response is not optional, it is required for survival. Stay with me here, because widening dealer spreads represent a form of invisible repricing already underway. Under normal conditions, dealer buyback prices remain within approximately 2 to 5% of spot value, preserving liquidity confidence. However, during structural transition phases, this gap can widen to 9% or even 15%, effectively reducing the real liquidation value of physical holdings before visible price charts reflect any meaningful change. This silent repricing shifts risk from dealers to investors without immediate visibility. Pay very close attention to this next insight, because dealer behavior often leads spot price by measurable time intervals. Historical patterns show that dealer bid reductions frequently precede major price movements by 10 to 25 days, particularly following volatility expansions greater than 35%. Dealers respond to changes in buyer demand velocity, which can decline by more than 40% during transitional phases, forcing dealers to reduce offers to prevent capital exposure. The most concerning aspect of this shift is its subtlety. Investors observing only spot price may perceive stability, yet their true liquidation value may have already declined by thousands of dollars across larger holdings. Dealers react to forward risk expectations, not present comfort. By the time spot prices visibly adjust, the underlying liquidity shift has already occurred.